about two ways that a person can make money. So the first one is they can spend less money, budgeting, that type of thing. The second one is that they can invest, they can save more money, or they can start a business. Hi guys, my name is Nosisa and welcome to my video. If you like this kind of content, please stick around. I do finance related videos, budgeting, saving, investments, those type of videos. So hopefully you'll stick around and make sure you catch my upcoming videos and the ones that I've done before. I am an accountant by profession, but I am not a financial advisor. So in terms of investments and things like that, it's also very important that a person does their own research and make sure that they make the right decisions for them. To understand why a person would invest, we need to understand what inflation is. Inflation means that the value of your money today is not the same as what it was maybe 10 years ago, and it won't be the same as what it will be 10 years in the future. For example, the price of brown bread in 2018 was 10 Rand, and today it's around 22 Rand. You can see that money loses its value over time. That is the principle of time value of money, and that's why a person would want to invest. The definition of inflation is that the rate of increase in prices over a given period of time. So a person would invest their money so that the returns of their investment outpace the rate of inflation. Other reasons for investment could be that a person wants to enjoy a comfortable future, but finding the best way to invest depends on a person's goals, their risk tolerance, and also how long they plan to hold the investment for. If you are younger, starting to invest early can actually help you make more money in the future, because the amount that you put in as your investments will compound in the coming years. So, for example, if you put in 100 Rand in an investment, then that 100 Rand will earn interest, and that interest is added to the principal amount. So, for example, if you put in 100 Rand in, and then now you have, for example, if it earns 10 Rand interest, then you have 110 Rand interest, and in the coming years, it will keep on compounding. So, if you start young, then you have a better chance of seeing higher returns in the future because you leave your money in the investment and you give it time to grow and compound. However, having said that, even if you are a little bit older, it's never too late to make an investment. You can invest now and see potential increase in your investment, and then also have money when you retire. Compounding simply means that the money that you invest will receive interest, and then that interest is then added to your amount you invested each year. So each year it keeps growing and growing by that interest that you get from your investment, and that's what compounding means. So there are about 4 asset classes. Asset classes are simply a group of investments that have similar characteristics. So number 1 is cash. Money markets are named after wholesale markets where banks lend and borrow large sums of money. Participants in the money market are the Reserve Bank, commercial banks, big companies, and large institutions as well. Market instrument is a low risk, high liquid asset, which means that it's easily converted into cash. These are short-term debt instruments, which means you invest them for less than a year, and issued by financial institutions or governments, and tend to have lower returns than higher risk investments. Unlike money invested in a bank, these tend to have no fixed yield. Instead, yield goes up and down depending on the interest earned on that investment. Quoted yields on a money market can fluctuate every day. Investors in money market funds can carry the possibility of decrease in yields. Although not in capital, however, they also profit from an increase. So money market funds offer investors a safe haven for cash during times of market uncertainty or during periods of transition. These returns may outperform other types of investments in the short term, but however are unlikely to do so in the long term. So investors tend to take refuge in these type of investment when the markets are very volatile, or to use these funds as a parking place while they decide which long-term investments to take up. So the goal of a money market fund is to maintain the value of the investment. Simply means that the goal is to maintain how much a person invests into that fund. So allowing access to the money when you need it, while generating a sound level of income. While these are parking places for money, they're not entirely risk-free. So the type of returns that a person can get from a money market is the interest gain on that investment and also the gain in capital of that investment. Though capital losses are unlikely for this type of investment, they're not entirely risk-free. So for example, if your issuer defaults on payment, there is a risk of capital loss of that investment. And also the returns of that investment may not keep up with inflation, which means that the value of investment will go down with time. So a money market is suitable if, for example, you need more stability and you seek high returns than bank deposits and only want to invest for about a year. The fund is ideal for emergency funds. It's ideal for risk-averse investors or investors that are waiting for the market to stabilize. The second class of assets is property shares. It's possible for a property to be purchased via a legal entity, like a company. So, for example, a person can buy shares in that property company. So this asset class gives investors exposure to various types of property, including industrial property, commercial property, and residential spaces. So these benefits offer an investor real estate ownership without the troubles of being a landlord. So for example, it's much easier to have a property share in a property company that manages the property as opposed to buying and selling homes in your own capacity. And unlike physical real estate, these shares are easily traded. So there are over 40 unit trusts, loan stocks, and real estate investment trust listed on the Johannesburg Stock Exchange, or also known as the JSE. The person would invest in property shares because it's equity and also returns they can get. And the share invested produces returns through the rise and fall of the share price over time, resulting in capital gains or losses. A person who also owns this kind of share receives regular shareholder distributions in the form of rental income distributed by that company. And because you're investing in a portion of the portfolio of the shares, so basically a piece of the pie, rather than a single building, there is less financial risk. So individuals with medium or high risk tolerance requiring medium or long-term capital and income growth would benefit from this type of investment. It is recommended that this type of investment is held for at least 5 years or longer. So the difference between this type of investment and a normal equity, a normal share in a listed company, is that the distribution is based on rental income over time and tend to be more reliable than a share in a listed company. So this kind of investment, a property share investment, is seen as less risky than a normal share in a listed company, since the distributions are more steadier. So just to also recap, in this kind of share, like a property share, you are buying a home in the name of a company. So there'll be different users that have shares in that company, and then that company owns and manages the property itself. Whereas real estate, for example, if you invest in real estate, you buy the homes and sell the homes in your own capacity. This type of investment usually accommodates more than one owner, and then that company, the property company that owns the actual property, is the owner of that property. And more than one individual can have shares in that company. So there are a different number of property share schemes available, each with its own risks and rewards. So before you invest, it's also a good idea to do your homework to find out how each of these schemes work. So the JSE does not permit direct share purchases. You'll have to purchase them through an accredited stockbroker or a bank, which will purchase the shares on your behalf. Once you choose a scheme, you'll have to open a brokerage account and deposit money into that account. And then you can start buying and selling property shares through that account. So individual investors can buy these shares through a mutual fund, exchange traded fund, or a company stock. Those stocks fluctuate over time. This provides somebody with a long-term passive income. So it's actually a very good idea to look into this option if it's something that works for you and it's something that suits you, and you've done your research and you make sure you understand the risks and the rewards, and that it's through an accredited stockbroker. So the third asset class is equity, which is simply known as shares. So shares, also known as ordinary shares, give somebody a piece of ownership of a company. So having shares in a company means that you get a profit if the company is sold, and also if the company makes dividend payment. Making a profit is one of the reasons why a person would invest in shares. So you can make profit in shares by buying shares at a low price and selling them at a high price. Shares are considered growth investments, as they help grow your investment over the medium or long term. Companies can also pay you a dividend, although they're not legally obligated to pay a dividend. And there's always a risk that a company can reduce the dividend payout or stop the dividend payout altogether. There's also a risk that the value of the share can drop below the amount that you paid for those shares. Prices can be very volatile from day to day and are generally best suited for long-term investments. Buying shares can work for you if you plan to invest for 5 years or longer, and you're also comfortable withstanding the ups and downs of the stock market. Shares have in the past delivered higher returns than other assets. However, they're also considered one of the most riskier types of investments. In my next video, I'm going to discuss how to buy shares under 100 Rand in South Africa. I'll link that in the description below and also in the end screen once I upload that video. The fourth kind of asset is bonds. So there are 4 categories of bond sold in the market. There are corporate bonds that are issued by companies. There are government bonds that are issued by the government. There are repo bonds, green bonds. Bonds allow investors to access investment potential of green technologies, services, and infrastructure. So the coupon rate, the rate of interest that the bond issuer will pay for the value of the bond as a percentage. For example, value is 10,000 Rand and the coupon rate is 5%. This means that the bond holder will receive 5% of 10,000 Rand, which is 500 Rand per year. And then coupon dates are the dates where the bond issuer will make interest payments. Maturity date is the date that the bond issuer will pay for the face value of that bond to the bond holder, so the investor. Investors will lend their money for regular interest payments, and after some time, that loan is paid back on the maturity date. So a person would choose these type of investments for regular interest payments. Buying bonds is considered less risky than any kind of investment. So individuals can choose the RSA retail savings bonds. A retail saving bond is an investment in the government of SA which earns fixed or inflation-linked interest for the term of the investment. Interest rates may apply depending on the maturity of the series. So remember, there are 3 different types of series for this type of investment, which is 2, 3, and 5 years. The inflation-linked retail savings bond series consists of bonds with either 3, 5, or 10 years maturity. The capital amount of these type of investment are adjusted with inflation, and the floating interest rate payable every 6 months on the interest payment date. So these kind of bonds are suitable if you want to make an investment for at least 3 years. I hope that this video has been helpful for you and that you've learned the different types of investments that are available in South Africa. Let me know what type of topics you would like me to cover below in the comment section. Thank you for watching and goodbye.